Howdy, y'all. Welcome to Liberty Call. Today is Thursday, December 14th, 2023. I hope everybody's having a great day out there. Programming note, there will not be a show on Friday. I will be traveling, so I could probably do something late in the day, but by the time I get a chance to settle down for the evening, I doubt I'll have a chance. So I might do something over the weekend to put out to wrap up the week. Maybe not. So we shall see. And then probably traveling Monday morning too. So anyways, you didn't come here to listen to my travel plans for the weekend, but you probably came here to hear about what happened in the markets. So if it is your first time watching Liberty Call, if you could do me a favor, if you could give me some thumbs up, like, share, subscribe, follow, press the notification bell. All right, let's go ahead and get into the numbers for today. And it looks like a lot of the steam that in yesterday's rally is kind of fallen off. The Dow Jones was up 0.43%, 158 points, closed at 37,248. S&P 500 was up 0.27%, closed at 47,19. NASDAQ up 0.19%, closed at 14,761. The VIX was up 1.64% today. It's at 1239. Canada was up 0.72, Brazil up 1.08, and Mexico up 3.4%. In Europe, Germany was down 0.08, the UK up 1 1/3, France up 0.59, the Netherlands up 0.37, Spain up 0.75%, Italy up 0.21, Switzerland up 0.19, and Portugal up 0.75% also. Let's see, Russian exchanges both red, MOEX down 0.77, RTSI down 0.68. And the Asian markets overnight, the Nikkei was down 0.8, Australia up 1.65, New Zealand up 1.27. In China, the Shanghai was down 1/3, the Shenzhen component down 0.62, China A50 down 2/3%, DJ Shanghai down 1/3%, Hang Seng up 0.74, and the Taiwan weighted up 1.05%. So, like I said, it seemed like the markets were just just like I said, the rally just kind of ran out of steam. We'll come over here and look at the chart. So this was the Dow, opened up, let's see what was up about, how many points is that? It doesn't really say. About 1/3%. It was up, and at its peak, it was up about 0.5%. Dropped down, let's see, about 0.6, and then went back up. Very similar chart with the S&P 500. It opened up about 0.6, and about halfway through the day, the rally just ran out of steam. If we go back 2 days, you can see where things really jumped about 2%, and then we had a bit of a pullback. So anyways, let's go ahead and get that off the screen. All righty. Where'd my stuff go? Here we are. Nope, that's not it. There we go. All right, let's get to today's news and the market recap. U.S. stocks pair some gains after breach in overbought levels, into overbought levels amid post-Fed rally. U.S. stocks experienced a pullback from recent gains as the post-Fed rally propelled them into technically overbought territory. The Dow, S&P, and NASDAQ retreated from session highs after breaching levels above 70 on the relative strength indicator, or index, a technical tool indicating overbought conditions. The surge came a day after the Federal Reserve's announcement of 3 projected rate cuts for next year, coupled with Fed Chair Jerome Powell opening discussions on potential rate cuts. Jobless claims fell by 19,000 to 202,000 for the week ending December 9th, falling short of economists' estimates. Concerns about material weakening ahead were raised, especially for small businesses facing pressure from higher interest rates. Although the increase hasn't translated into layoffs yet, analysts predict it might eventually lead to such outcomes. Despite these concerns, U.S. retail sales unexpectedly rose by 0.3% in November, reflecting the strength of consumer spending as the holiday shopping season commenced. Adobe Systems faced a 7% drop in stock value after issuing conservative guidance for 2024's earnings and revenue. Meanwhile, Apple retreated from its all-time intraday high of 199.62, with Alphabet and Microsoft Corporation also trading in the red as investors took profits on big tech. In other sectors, semiconductor stocks reached all-time highs, driven by Intel's rise to a fresh 52-week high after unveiling new AI chips. Moderna and Rivian Automotive experienced notable increases, with Moderna's stock rising over 12% after positive experimental results for its messenger RNA cancer vaccine co-developed with Merck. Rivian surged more than 12% after securing a deal with AT&T to supply commercial vans and R1 vehicles. Occidental Petroleum received a nearly 3% boost, leading the broader energy sector following Warren Buffett's Berkshire Hathaway acquiring nearly 10.5 million shares of the oil giant for about $588.7 million. The energy sector also benefited from a jump in oil prices amid growing optimism about the U.S. economy and expectations for an accommodative Fed in the coming year. Yeah, everybody's thrilled that the Fed is, well, in their opinion, is being more accommodative to big business and Wall Street with the proposal of lowering rates. We shall see if that happens. We should also see if that soft landing they've been talking about for a year or two is actually going to occur, or if we're going to have, crash and burn on the flight deck. So we shall see. All right, next up, U.S. economy still resilient as retail sales beat expectations. Layoffs stay low. All right, in a surprising turn of events, U.S. retail sales rebounded in November, defying expectations and signaling a robust start to the holiday shopping season. Although, let me stop here. I have seen tons of videos of malls that are just empty. So, people are buying stuff, but I think they're doing it, online or at like discount retailers, because I've seen, and again, these are just anecdotal reports. So, take it with a grain of salt. I haven't been to a mall in a couple of years probably. So, but like I said, I've seen multiple pictures of, what you would think would be busy shopping season, like weekends and things like that. And like the entire gallery is just, empty. So, all right, getting back into it. The Commerce Department reported a 0.3% increase in retail sales, countering a 0.2% decline in October and surpassing economists' forecasts of a 0.1% decrease. Year on year, retail sales grew by 4.1% in November, reflecting consumers' resilience amid higher borrowing costs and prices. The stronger than expected retail sales data challenges the prevailing market sentiment that anticipated a potential rate cut by the Federal Reserve in March. The central bank had just held interest rates steady and indicated a shift toward lower borrowing costs in 2024 in its recent economic projections. Retailers engaging in deep discounting strategies have fueled the rebound in sales, with significant promotions enticing consumers. Lower gasoline prices have also contributed to increased spending in other areas. The rise in sales was broad-based, covering various sectors. Online retail sales rebounded by 1%, while motor vehicle and parts dealers saw a 0.5% increase, and furniture store sales jumped by 0.9%. The report underscores the continuing strength of the U.S. consumer, buoyed by a robust labor market. Despite concerns about a potential economic slowdown, the resilience of consumer spending has defied recession fears. Analysts view the positive retail sales data as a signal that the Federal Reserve is unlikely to implement rapid and extensive rate cuts, as the market had previously priced in. While stocks on Wall Street responded positively to the news, trading higher while the dollar weakened against a basket of currencies. The unexpected strong retail sales data challenges the narrative of a looming recession in 23, reinforcing the notion that the consumer and the economy remain resilient. So, people keep spending money. So, although I do hear lots, again, it's all anecdotal, people complaining about, there's just not as much money to go around. So we shall see how that affects us going forward. All right, last up from Zero Hedge, the Fed is far more reluctant to trigger a recession during an election year. Shocking. We saw that in 2020. This is written by Peter Cheer of Academy Securities. Get to my summary here. All right, the Federal Reserve's recent policy shift, as reflected in the updated dot plot in Chair Jerome Powell's press conference, has prompted a significant reconsideration of market dynamics. The central bank's revised outlook, including a potential increase in rate cuts for 2024, has challenged earlier assumptions about the impact of interest rates on asset prices. The initial response to the Fed's announcement was an expectation that yields on 10-year treasuries would struggle to stay below 4.2%, especially if economic data remained robust. However, the new policy stance suggests a departure from the previous assumption that the Fed would be more inclined to tap the brakes on the economy to prevent inflation. The market now faces a scenario where lower yields are accommodated by the central bank, altering the traditional correlation between yields and stock performance. While there was an initial inclination to fade the market's reaction, doubts emerged about the validity of earlier perspectives. The Federal Reserve's apparent comfort with easing of financial conditions and Powell's dismissal of hawkish rhetoric marked a significant departure from previous practices. Powell's almost celebratory tone during the press conference, emphasizing victory over inflation fears, added to the shift in the narrative. An intriguing factor in this reconsideration is the potential impact of the Fed's stance during an election year. The Fed, while not explicitly political, may be cautious about triggering a recession in such a crucial time, considering the influence of economic conditions on elections. In light of these developments, there is a growing preference for laggards in the market, including small and regional banks, small caps, commercial real estate, disruptive tech, and energy. The belief is that these sectors could benefit from the Federal Reserve's more accommodative stance, lower yields, potential rate cuts, and compressed spreads. The overall sentiment is leaning towards a more bullish outlook for these laggards compared to the broader market. While acknowledging challenges such as the rising Treasury debt problem and potential positive developments from China, the overall market outlook appears to be shaped by the newfound confidence in the Federal Reserve's support, giving rise to optimism for various asset classes. So yeah, everyone seems to think the inflation has been, just wiped away. We're all good. We're going to just ease into 2024 and, life's going to be good, fine. So we shall see. I have my reservations about that. I think things are going to be a little bumpier than the financial journalists like to talk about in the talking heads on TV. So anyways, all right. Well, that's everything I had for today. Like I said, probably no show tomorrow. Might do one over the weekend just to recap the week, and probably not one on Monday either. So the weekly update will go out via email like normal, and everything else. So stay posted. All right. Well, I hope everyone has a wonderful evening, and I shall talk to you next time I broadcast. Adios.